You see the rocket emojis, the Reddit memes, the hype, and that's the story most people get. But the real story, the one that matters, is in the data. We're seeing these major divergences between what social media is screaming about and where the big institutional money is actually flowing. It's creating this tightly coiled spring in a few very specific, heavily shorted stocks. So today, we're going to decode the mechanics of this anomaly, not with hype, but with a serious deep dive into the market's plumbing.
Okay, let's look at the data. To really understand this whole phenomenon, we need to break it down into 4 key parts: what the anomaly actually is, the engine that drives it, how the big institutions play a role, and finally, what the outlook is.
So here's our game plan. First, we'll define the anomaly itself. Then, we're going to pop the hood and dissect the short squeeze engine. After that, we'll follow the money, the institutional flow. And finally, we'll pull it all together into a clear outlook, weighing the hard data against all that hype.
All right, Section 1, the Meme Stock Anomaly. At its very core, this is a battle. It's a conflict between what a company should be worth based on its financials and the raw, collective power of a community deciding its price.
So first up, let's get a really clear definition. A meme stock isn't about its industry or its market cap. Nope, it's all about how it grabs the attention of retail traders online. It creates this feedback loop where the more people talk about it, the more the price moves, which gets more people talking. It's a phenomenon driven purely by social dynamics.
And the scale of that social dynamic? It is huge. Just look at the Wall Street Bets subreddit, 16 million members. Now look, of course, not all of them are active traders buying every day, but what this number shows is the massive potential for coordinated attention on a single stock, and that attention can become an incredibly powerful market force.
This right here, this is the absolute heart of the matter. On one side, you have the old-school fundamental value, things like earnings, revenue, the stuff Wall Street has used for a century. And on the other side, social sentiment. In the world of meme stocks, the price can totally disconnect from the company's health and trade entirely on a story, on a narrative, on collective belief. This divergence is exactly what fuels the insane volatility we see.
Now for Section 2. Let's get into the mechanics of the short squeeze. This is the engine that powers these absolutely explosive moves.
To get a short squeeze, you first have to understand short selling. It's basically a bet that a stock's price is going to fall. But here is the absolutely crucial part, the risk. If you buy a stock, what's the most you can lose? Whatever you put in, right? It can go to zero. But when you short a stock, your potential loss is infinite. There is no ceiling on how high a stock price can go. And that vulnerability, that is the key.
This breaks down the cascade perfectly. I want you to think of a heavily shorted stock as a tightly coiled spring. Step 1, a whole bunch of retail investors start buying, and that puts pressure on the spring. Step 2, the price starts to rise. Step 3, the short sellers start feeling the pain and they're forced to buy shares just to stop the bleeding. But what does that do? It adds more buying pressure. That's Step 4, the feedback loop. Their buying pushes the price even higher, which forces even more shorts to cover. It's a powerful self-fueling cycle.
But here's where a lot of people get it wrong. It's a huge mistake to just assume all these companies are failing businesses. Take a look. BlackBerry has successfully pivoted to software. Its IoT revenue is up 25%. Intel saw its revenue grow by 9%. And, NVIDIA is literally at the center of the entire AI revolution. The social momentum often targets companies that also have a real, believable turnaround story, and that just adds fundamental fuel to the fire.
Okay, that brings us to Section 3. The retail story is fascinating, for sure. But to see the whole board, you have to follow the institutional flow. You have to understand the so-called smart money.
This quote from Investors Business Daily is just brilliant. It explains that these giant funds aren't always super agile. Their size is actually a constraint. It forces them to invest in big, liquid stocks, which makes their moves kind of predictable. They're not the villains in this story. They're just market participants whose enormous size creates patterns, and those patterns can create opportunities for traders who are a bit more nimble. So we know these massive funds need to move huge amounts of cash. The next logical question has to be, how on earth does the market's plumbing system let them do that without showing their entire hand to the world?
The key is to just understand the structure of the game you're playing. Payment for order flow, or PFOF. That's how a lot of zero-commission brokers make their money, by routing your trades. Then you have dark pools. These are basically private stock exchanges where institutions can trade massive blocks of shares away from the public eye so they don't move the price. Now listen, these aren't conspiracies. They're just structural realities of the modern market. And by tracking things like unusual options activity and block trade data, you can often spot the institutional footprints before the moves are obvious to everyone else.
And that brings us to our final section, the outlook. So when we put all these pieces together, how should we be thinking about the meme stock phenomenon going forward? Let's lay out the bull case versus the bear case.
So the bull case says this isn't a fad. Pandora's box has been opened, and coordinated retail is now a permanent force in the market. Plus, as we saw, some of these companies actually have solid fundamentals. The bear case, on the other hand, just points to the charts. Most of these stocks are trading way below their crazy peaks. It argues that in the long run, fundamentals always win, and trading on pure hype is just incredibly high risk.
So, you're faced with these two competing realities. What is the single most important takeaway for anyone trying to trade or invest in this wild environment?
You know, ultimately it all comes down to this. Stay disciplined and stay liquid. You have to make decisions based on data. You have to define your risk before you ever enter a trade. And you can't let social media hype or emotion drive your strategy.
And of course, please remember, this analysis is purely for educational purposes. It's based on data that is current as of right now. And that data changes, and it changes fast. Always do your own due diligence before making any kind of investment decision.
We are tracking these flows in real time. So while you're analyzing the next move, go ahead and check out the tools in the description. You can sign up for Public and get $20 in free assets, check out Webull for that BTC promo, or take a look into NVIDIA on Moomoo. All the links are right down below. And hey, be sure to like and subscribe for more deep dive analysis.